So my name is Ben Lafort. I'm OFA's economist in our policy department, and very happy to be introducing Kurt O'Schlegel today. Kurt, I'll just read off Kurt's bio. He's done a number of these webinars for us in the past, so he does an amazing job of delivering incredible amount of information in a way that's easy to digest. So Kurt is a tax specialist partner with MNP. His practices focus on owner-managed businesses with a particular emphasis on agribusiness. And the areas of expertise include federal and provincial income tax, including corporate restructuring, estate planning, transition and succession planning, personal and corporate tax planning. He also provides his services to other CPA firms to assist with their clients' tax matters. Kurt is a graduate of the Honors Economics program at Wilfrid Laurier University. He joined what is now BDO Canada LLP in 1988, attained his charter accountant designation in 1989, and became partner in 1995. He was admitted as a fellow of the Institute of Chartered Professional Accountants in 2011, and is also a member of the Society of Trust and Estate Planning Practitioners. Kurt was the National Agricultural Tax Leader at BDO LLP before joining MNP January of this year. Kurt was a lecturer and course coordinator for CPA Canada's income tax practice for the general practitioner. I did that for 15 years. He is the co-author of the national publication Taxation of Farmers and Fishermen, which you cannot see, but it's sitting on my shelf. I renew that subscription every year. And a contributor to the book Agricultural Law in Canada. He has been a speaker and tutor to various tax conferences and was a tutor at the Ontario School of Accountancy. Kurt was a frequent author and presenter for the annual farm tax business seminars that OMAFRA used to put on. Kurt grew up on a farm in Harrison, Ontario area, and also worked in the family meat processing business, Harrison Packing Company, which is currently owned and operated by his two younger brothers. So without any further ado, I will throw it over to Kurt. Sorry, actually, one last thing I'll mention is if you have questions throughout, please just type them into the chat. And at the end of Kurt's presentation, I'll read them out in the order in which they were written. So yes, over to you, Kurt. Thank you so much.
Great. Thank you very much for the great introduction, Ben. That's a lot of history. I'm getting old. Thanks everybody for joining today. I appreciate being asked to do this and appreciate your time. We're going to go through a bunch of slides here on the budget and some other tax matters we thought would be of interest. For those of you that were on our M&P Ag webinar last week, it's a similar slide deck, but we'll go through the points again. Never hurts to hear them and talk about some strategies. Hopefully I keep it clear and relevant, and hopefully it doesn't get too boring for you because it is tax. And we'll do our best to answer questions at the end of the day. First of all, I just want to give a bit of a overview about M&P itself. Since I joined M&P the beginning of this year, I've had many clients when I've gone about across Ontario, or especially up in my neck of the woods, which is Hanover, Midwestern Ontario, asking about, they don't know what the firm is. So it did start in Brandon in 1958. They have been centered primarily in Western Canada, primarily in agriculture. They have a very large agriculture client base. And now it's basically a national firm across Canada, from the East Coast to the West Coast. And it puts a significant importance on agriculture. So we are a large organization, but our partners and our team members, our staff are located in the smaller communities, people you'll run into at the arena or the feed store or at the co-op. So we have a lot of resources to bring to bear through M&P. We have an extensive history in agriculture, which I've mentioned. We have over 1,000 of our team members that are dedicated to simply serving our agriculture clients. So we know the ins and the outs. We know the lingo and the terms. And as Ben mentioned, I grew up on a small farm, but the main family business was meat processing. A lot of our staff grew up on farms. A lot of our staff still farm or active in their family farms. So we have the folks with the right background, I think, to understand your business. We're going to run through a budget update. I'm going to talk about some of the intergenerational business transfer rules that we have now. I'm going to talk about minimum tax because it's a bit of a sleeper, about the farm rollover rules, those special rules that farmers can use, and some Ontario specific things around land transfer tax and probate. So for the budget update, to be honest, it was a budget where the goals of the budget, I'm going to go back one. So the goal of the budget was to build the Canadian economy, increase our competitiveness, supercharge growth. It was to empower Canadians by reducing costs, decreasing housing costs by investing in affordable housing, and reducing spending, which they referred to as spending less to invest more. And it was to protect Canadian sovereignty and keep Canada safe. This is the first time that the government has ever separated the capital budget from the operating budget. And regardless of that, the projected deficit for 2025-26 is 78.3 billion, which is double what it was forecast to be, and is the largest deficit since the pandemic. And by 2029-2030, it's still forecasted to be over 56 billion, but coming down to that level. Some of you may have heard they're planning to cut public service. So not that long ago, there was an announcement about 68,000 public service workers may be eligible for early retirement. And that was one of their goals. They said they want to cut public service jobs by about 40,000 from the peak of 368,000 back in 2024. One thing that was in the budget is what they call productivity super deductions. Now, we have already something called the accelerated investment incentive property. We've had that for a while, and that's when you buy your equipment and whatnot. We could depreciate it faster for tax. And that's been phasing out. It's in a phase out stage now. So it just goes down every year until it gets back to the normal rules. So what they did in the budget what they did in the budget is they call it the re-accelerated investment incentives. So for anything acquired on or after Jan 1 of 25, so the beginning of this year, we are into now re-accelerate investment incentives. So we're back to writing off acquisitions like tractors, equipment, whatever, quicker in the first year you buy it, and then it will go down over the years. And I have a chart I'll show you in a sec. The big thing they introduced around manufacturing and processing, or what we call M&P, was an immediate expensing of new M&P buildings built or acquired on or after the budget date, which was November 4th and before 2030. So if somebody builds a $20 million manufacturing plant, they can write the whole thing off. Now, what needs to be understood is that for farming purposes, for federal income tax purposes, farming is not considered manufacturing and processing. That's been like that for a long time. So those M&P benefits aren't there, but the re-accelerated investment incentive will be. There are some Ontario-specific ones that have been there a bit. The Ontario Regional Opportunities Tax Credit, it's been there for a while. Some of you have probably used it, building a new barn or an addition or a shed. And it's for corporations. It's in certain regions of Ontario. There's designated areas where this applies. And you can get a refundable credit if you spend $500,000 or more. The maximum refundable credit's $45,000. So we've certainly done that with a number of our clients. It has to be non-residential, like a barn. 90% or more of the floor space has to be non-residential use. The other one they have is the Ontario-made manufacturing investment tax credit. That came in place a few years ago. It's a refundable credit. I say the maximum's $2 million. It's 10% on $20 million. The 2025 Ontario budget did enhance that to 15% on $20 million. So for a maximum of $3 million now, and that's fully refundable. But again, this is for manufacturing and processing, which farming isn't. However, some farmers may have further processing on their property. Somebody might be raising beef cattle and also have their own meat processing facility. growing wheat, and maybe you have your own flour processing facility, somebody with milk and maybe their own milk processing facility. So there are agribusinesses certainly that do manufacturing and processing, but the farming itself, the basic farming, is not considered that. But anyway, those are some sort of Ontario specific ones to sort of look out for. And there's my chart. So basically, these classes are the classes that we put things in on your tax returns when we depreciate what you're buying. And then the normal rate is what we can depreciate it at. And in the first year, we get half of that normal rate. And before the 2025 budget, that's in blue there, that's sort of where we were at. It was being phased down to 2 times normal, and then it would be phased out over the coming years. The red is now what we're back up to, 3 times the normal tax depreciation in the year you acquire, say, a tractor or some other piece of equipment. And so they're allowing a quicker write-off now on these acquisitions. And the draft legislation indicates it is after Jan 1, 2025. Okay. The one thing I want to talk about is trusts. I'm going to try not to get too technical on this one, and why it's important is we do see a lot of trusts in agriculture. We do see bare trusts in agriculture. So trust reporting requirements came into place 1st December 2023, enhanced trust reporting it was called, new forms to file. And the government came out for the first time and said bare trusts have to file. And what's a bare trust? A bare trust is where the trustee holds legal title to the property. So somebody has legal ownership, but somebody else is the beneficial owner, and that beneficial owner has full control of the property and entitlement. It makes all the decisions about the property. The legal owner can't make any decisions about it. They're basically an agent holding the property for the real beneficial owner. We've never had to file tax returns for bare trusts in the past. They've been ignored for tax purposes. So they said we had the file. Then and for 2023, on March 28, 24, 2 days before the filing deadline for 2023 returns, they announced that it had been postponed for 2023. So regardless that you spent tons of time doing the work and paid professional fees, they said, nope, we're not going to do it for 2023. Then they came along and said, we're not going to require filing for bare trust for 2024. So we said, fine, that's fine. We understand that. And we're getting geared up for 2025. Well, then budget 2025 came along and said, no, we won't need to do bare trust reporting for 2025. It's now been postponed until 2026. So it's an ongoing saga of postponement. Unfortunately, not cancellation. We wish they would just say you don't have to file. What are bare trusts? So, sometimes the kids are building a house and the bank says, a parent has to go on title for financing or whatever, or for some other reason, a parent's on title with their children. And if somebody asked you as the parent, oh, do you own that little chunk of that property? Well, no, it belongs to my child. You're technically holding that in trust for them, likely, because they're making the decisions. Sometimes we have corporations holding land in bare trust for individuals or vice versa. Sometimes the trusts are there to avoid property mergers on abutting farms and things like that. Sometimes land is held in a spouse's or child's name for estate or tax planning, maybe just to avoid probate. So, mom or dad add the kids to their account. But if you ask anybody, mom or dad call the shots, it's their account, they report all the income, it's their money. The kids don't have any say over the money or how it gets spent or used. There could be a bare trust there. And we also see it a lot in agriculture when we do specific types of tax reorganizations where we're moving farms around between corporations, where we want to defer or eliminate the land transfer tax. It usually needs a bare trust agreement to be in place. So all that being said, they want those trusts to be filed. And they've now come out with carve-outs where they say, hey, you don't have to do that filing. One of them is each beneficiary is the legal owner. So as long as the beneficiaries and legal owners are exactly the same people, nobody has to file. Great, understood. Legal owners are related to each other, and they own the real property as the principal residence of one legal owner. that's the situation where, dad or mom had to be added to the title of a property so the child could get a mortgage to build a house. Well, that house was likely could be the principal residence of the child. All the legal owners, mom, dad, and the child are related. We don't have to file. The same with a spouse. So technically, like my wife owns our house. Is she holding half of that house in trust for me? Would there be a filing requirement? They're saying now, no, there isn't, but that was an issue before. And the other one's partnerships. That was a big issue. We got lots of farm partnerships, husband, wives, parents, children that operate their farm operations as partnerships. We now have an out where the property is used solely for the benefit of the partnership, and all the legal owners are partners. Now, not all the partners have to be on title, but whoever is on title of a partnership owned farm has to be a partner of the partnership. And the partnership's required to file an income tax partnership information return. Now, a lot of partnerships of individuals have an exemption from filing that return. It's a Canada Revenue Agency administrative exemption. You don't have to file this special partnership information return. That doesn't mean you don't get this exemption, because that out is an administrative exemption. And related for these purposes has been expanded, because technically you're not related to these people for tax purposes, but you are for these rules: aunts, uncles, nieces, and nephews. Okay. So those are carve outs, which means we don't have to file, thank goodness. They also came out with rules that say, hey, if you don't meet any of the carve outs, there might be another way out. And this is basically for any trusts. So trusts that exist for less than 3 months during the year, trusts that hold assets valued at $50,000 or less throughout the year, and that's at value, fair value, not cost, where each trustee is an individual, each beneficiary is an individual, and the total fair value of the assets throughout the year, again, at any time of the year, does not exceed $250,000 fair value. And there's a list of certain assets. And the last one's about lawyers and their trust accounts, where they get some exemptions from this filing. So it's not simple, unfortunately. They've made it complicated, but they just want to get to know all about trusts and any kind of trusts out there that aren't exempt or carved out. So why do we care? If you have a trust, even if it doesn't owe any income tax, even there's no, why am I filing a trust tax return if there's nothing to report or no tax? If it has a reporting obligation under this enhanced reporting requirement, there's a special schedule called Schedule 15 that has to go to the government as part of the tax return. This reports all the individuals involved, all the names, addresses, birth dates, social insurance numbers for whoever settled the trust, whoever the trustees are, whoever the beneficiaries are. They want all this information. Obviously, they want it for a reason. They're going to start doing some analysis and looking at auditing some of these things, I'm sure. But if you have to file this and you don't file it, there's a penalty. Doesn't matter if you owe tax or not, or the trust owes tax or not. It's $25 a day to a maximum of $2,500. And if the government comes to you and says, we think you didn't file on purpose, we think you've been grossly negligent, then the penalty becomes the greater of $2,500 and $5,000 of the maximum value of the property held by the trust or estate during the year. Now, let's say a trust owns a property that has a value of $500,000 and they apply this gross negligence, that would be a $25,000 penalty. So these penalties here can apply regardless of the fact of whether or not the trust owes tax. If the trust doesn't get a carve out, or it's not one of those listed arrangements we went through, there's a filing requirement. So I just caution people, it's better safe than sorry. Talk to your advisor if you have any concerns about whether you should be filing or not in certain situations. The other thing that came out in the budget was the Canadian Entrepreneur Incentive was announced in the 2024 budget. They changed it to include farmers. This came out because the government, if you'll recall, in 2024 had announced we're going to tax more of your capital gains. After June 24th, 24, I think that was the date, we're going to start taxing more of your capital gains, which nobody liked. And so they came out and said, well, we'll also have this Canadian Entrepreneur Incentive. Now, The government changed their minds once we had the new government and everything. The government changed its mind, did not increase the inclusion rate of capital gains. So the inclusion rate stayed the same. It didn't go up as planned. So they canceled this because it wasn't necessary anymore. So that sort of gone by the wayside. The other thing they've done in this budget, the 2025 budget, which is interesting, is they're saying there's a crackdown. They're not happy with truckers in particular. This is on the trucking industry, but I warn you, it's the tip of the iceberg. They're not happy with truckers who are treated as independent contractors of trucking companies rather than employees. So they're not getting employee benefits, maybe they're not getting, coverage through EI, all the things employees should get. They think that's being abused. They have budgeted $77 million over the next 4 years, and then about $20 million annually after that for the Canada Revenue Agency to start penalizing trucking companies who don't file the T4As, like report how much money they're paying to their trucking contractors. There used to be a moratorium on that. That's been there for years, no penalties, but now the penalties are coming back for trucking businesses. If you pay, a trucking company pays over $500 to somebody, they have to issue a tax slip. There's penalties for late filing. They're going to have the Employment and Social Development Canada start enforcing labor standard codes under this. And I heard that they've launched a blitz in the GTA and the Hamilton area to identify these misclassifications and then have penalties for violations, and they're going to coordinate with CRA. I think we're going to see more of this. And if the contractor's incorporated, they're an incorporated employee. If the CRA comes and says you're an incorporated employee, the tax rate on income in a corporation where it's considered an incorporated employee is very punitive, and it's very high. So I think we're going to see some more activity on this, unfortunately. Not sure why they were so ticked off about it, to be honest. The underused housing tax. Oh my gosh, that came in, and that was such a, I can't swear on this. That was such a boondoggle. It was a waste of your time and money. It was a waste of a lot of professionals' time and money. Had to file returns that you shouldn't have had to file. Then they came out and finally said a year later, well, we're changing the rules. So most Canadian citizen-owned corporations, partnerships didn't have to file, but others still had to. It's been completely eliminated now, starting 2025. And so they said it wasn't bringing in as much money as it was costing to administer. So that's the sign of a good tax, I guess, is it's costing a lot more red tape than it's bringing in for the folks. So that's by the wayside. A lot of you will know that last year they increased the capital gain exemption to $1.25 million, and that the government, the Canada Revenue Agency for 2024 has applied that limit when it's assessed tax returns. Technically not yet law, but it is now in the Notice of Ways and Means that was released, which is draft legislation. And it's indexed, so it's actually going to 1.275 million. I think this year, 1.275 in 2026. So that's good news. The next thing I want to touch on is the intergenerational business transfer rules. These came in January 1, 2024. Now, these are not the farm rollover rules, which we'll touch on a bit, but this is for incorporated operations, so farm corporations, where the parents maybe want to sell some shares to use their capital gain exemption and actually get some money, to live off of in retirement or for estate equalization or whatever is necessary. Before these rules came in, there was another version of them. But before that, for many years, we could not have the parents sell their shares of the family farm corporation to another corporation that's controlled by their children and get the parents, one, capital gain treatment, and two, the ability to use their capital gain exemption for qualified farm property, that $1.25 million that's indexed now. And so this allows that to happen, which is great because capital gains are always better than dividends. And when you get to use your gain exemption, that's even better, right? So they're updated to allow that. It's to reduce the tax burden on the transfer of the family farm corporation. It also applies to other family business corporations, what we call qualified small business corps. It's to allow the tax-free, tax-efficient transfer between generations. Because if you're taxed on a dividend, the high rate right now on those is about 47%. On capital gains is about 27%, so it's a big difference. And if you have the exemption, maybe nothing. So those rules are there now. We've used them a number of times, but the government is very concerned about abuse, very concerned about having a lot of strict rules around it so that it is used for actual bona fide intergenerational transfers. They want to make sure that it's used for the right reasons. So the vendor of the company has to be you, the taxpayer, the individual, and your spouse. You sell to a corporation that's controlled by your child, and that's expanded as shown on the screen. It can now include nieces, nephews, etc., who are over 18 years of old. You're selling shares of your family farm corporation or qualified small business corporation that's eligible for the gain exemption. Those definitions alone have a lot of conditions around them, mainly asset tests. They're all asset-based tests that 90% or more of the assets of the corporation are used principally in the farming business or active business carried on in Canada in which you're actively involved. So it's important to make sure you're onside those definitions. The other thing is you've not used this provision in the past for the same company or certain related entities. So it's sort of a one kick at the can thing. So we have to be careful when we're doing this as to how much we're using this special rule that gives the parents gain treatment. We may not just limit it to the gain exemption because we get one kick at the can, and it can create a pipeline for the parents to get some funds or the estate to get some funds out of the company in the long term on a pretty tax efficient basis. So this is a busy slide, and I don't want to go through it all, but basically I just want to get across that the government's got two streams. One's an immediate one, one's a gradual one. And between the two streams, yeah, there's different dates in that, but what they're really, if you look at this, what they're getting at is, has legal control changed to the child, the voting of the company, the voting shares? Has factual control changed? The immediate transfer requires factual control. Have the parents reduced their ownership in the company? You'll see there that right after the parents sell, they have to own less than 50% of the shares of any class other than a specified class of shares. And all a specified class of shares is, it's a special class that is really like debt in a way. They're fixed value shares. They have a set rate of interest in the Income Tax Act, or dividends, sorry. So they're like debt-like shares, I would call them. The other thing is they're going, well, it's enough the kids to get control, to get ownership, but we need the management to change. And this one we struggle with. The parents have to cease managing the day-to-day operations within 36 months for immediate, 60 months for the gradual one. This is tax law telling the parents you can give advice, but you cannot supervise or manage. I don't know how they're going to audit that. We don't know what they'll ask for proof, but that's in the Income Tax Act. The Canada Revenue Agency has also come out and said the parents cannot remain directors of the company. So if you're a parent and you're a director of your family farm corp and you want to use these rules, you have to be comfortable giving up legal control. You have to be comfortable with the requirement to restrict how much you own. You have to be comfortable with giving up day-to-day operations within 36 months or 60, depending on which stream you use. And you have to be comfortable coming off as a director of the corporation. They basically are forcing the parents to get out because they're saying, hey, we're giving you these special rules. You got to use them to do the transition and the succession, right? Within 36 months, you can't hold any shares except these debt-like shares. So, it's a pretty quick period. The children have to stay actively engaged. The immediate one for 36 months. On the other one, it's the later of 60 months and the final sale time, which can be up to 10 years. And the other one with the gradual one, which I don't really like it, is it says to the parents by the end of the 10-year period, your ownership in the family farm corporation has to be reduced to 50% or less of the value that you had when this transaction started 10 years earlier. and that includes all the shares you owned and all the loans the company owed you. You add it all up, you have to be below 50%. That can be very tough given the value of farmland and quota and everything to cash the parents out down to 50% within 10 years can be very difficult. So we don't really like that option as much, to be honest about it. So they're the rules. We have to follow them, and we go through them all with the client. And some clients are comfortable proceeding, and some clients aren't comfortable with all the conditions. Maybe it's not the right time for it. If you do use one of these rules, there is an election form to be filed on on or before the due date of your tax return of the parents, the vendors. Why do we have to file this election? We have to tell the government which stream we're using, the immediate or the long-term gradual one, because those conditions have to be monitored now for years going forward. There's a joint liability for tax, so the children involved are jointly liable for any taxes assessed in this transaction. And you're going, well, what taxes? So if the children, you do this deal, the children are likely the ones that will cause one of those conditions over the 36 months or the 10 years as required. They're likely the ones to cause one of those conditions to go offside. Something goes wrong. They don't adhere to the conditions of the rules. What the government can do is go back to the year the parent sold the shares, where the parent thought they had a capital gain, the parent thought they used their farm gain exemption, tax was what it was, maybe not too bad. They now go back to that year and they assess the parents as being taxed on dividends. No capital gain exemption, 20% higher tax rate. It'll be a big tax bill. And they're saying to the children, you are jointly liable with your parents for that tax bill because you maybe created the problem. They've also extended the reassessment periods. What that means, if you use either of these options, the government has the right to look at your tax returns for an additional 3 years beyond the normal time right now. So it's normally 3, add another 3. It's normally 3, add another 10 for the gradual one. One benefit is there is a 10-year reserve. And what that means, the kids set up a company, they buy the parent shares, they're going to pay the parents off, who knows how many years, 10 years, 20 years, maybe not all paid off at all. This allows the parents to spread their capital gain out to a maximum of 10 years, which can help with, the old age security, trying to avoid the clawback of that, maybe helps with alternative minimum tax reduction. So that is one benefit of the rules. So these rules are there now. They've been there since Jan 24, and there's something we can use. It's another tool in the toolkit, so to speak. Other insights. So alternative minimum tax. This changed dramatically Jan 1, 2024. They changed the rate. It went up considerably. They also changed the basic exemption from the tax. So being exempt from it went up considerably, but they changed the rules a lot in how we calculate the math. It's complicated math, not going to get into it, but what we're seeing is more and more capital gains, particularly farm sales, using the capital gain exemptions, are creating significant minimum tax liabilities higher than we've seen in the past. This is the minimum tax calculation is done every year that your tax return's done, or supposed to be. And most years it won't kick in because your regular tax would be higher than the minimum tax that's calculated. In the years you have a large capital gain and things like that, the capital gains are adjusted for the minimum tax calculation. More of the gain is taxable for minimum tax. So that's when we get into, well, the minimum tax is now higher than the regular tax. So to the extent it's higher, you have to pay this minimum tax. Now, once you pay this minimum tax, you do have 7 years to use it. It's like paying a big tax installment up front. And for the next 7 years, when your regular tax is higher than what the minimum tax would be in those years, so back to normal years, you would get to use this minimum tax as a credit against the next 7 years of your regular tax. What happens after 7 years? If you haven't used it all, it's gone. It's an absolute cost. So for somebody with relatively low income who sells their farm, cash deal on closing, will likely have minimum tax, to be honest. Can they recover it over the next 7 years is going to be the question. Can we generate enough income that they recover it all? Planning's important. Planning prior to the sale is important. Looking at capital gains reserves to minimize the AMT exposure. We call it AMT for short form. Assets held in a corporation. A corporation's not subject to minimum tax. So there's different things we're looking at now as how do we reduce the minimum tax exposure for our clients, but the planning has to be done in advance. It's too late. It's too late after the fact, right? The farm rollover rules, I wanted to touch on those quickly. Those have been around a long time. And there's rules for farmland, the real estate that can roll to children. Quota can roll to children, personally owned quota. Shares of the family farm corporation or an interest in a family farm partnership. Now, those last two, the shares of a family farm corporation, interest in a family farm partnership, they're very specifically defined in the Act. And even the farm land and quota, there's provisions in the Act. But if you farm and that's what you do, you're going to have eligible assets, no problem. And they can be sold to your children between the cost, the original cost of the asset, or what it's worth today. You have that flexibility while you're alive. If you sell them while you're alive to trigger the value you want or what gain you want, you actually have to take consideration. It can be a promissory note or an IOU type thing, but there actually has to be something changing hands. When somebody passes away and the rules apply, by default, it goes without tax to the children at its original cost, but the executors of the deceased can file a special election with the tax return to pick any value they want, basically between the cost and the fair value, and use up the parent's gain exemption on their last return. It's sort of the last kick at the can. If a parent dies, hasn't used all their farm capital gain exemption, there's generally the ability to file election on transfer to children of eligible farms to use that up. A lot of the tests are around the assets being used principally in the business of farming. We usually say, if it's so many acres is more than 50% of the usable acreage used in farming, check, right? We've owned it for 50 years or 30 years, or how many ever years we've owned it. Have we used it for more than 50 years of ownership in an eligible farming activity in which we're actively involved? You check the box. Now, some of the common pitfalls we're seeing right now, and these are real life pitfalls, we are seeing offside family farm corporations. They're not family farm corporations if they're offside, which means what? Which means they have too much non-farm assets sitting in them. From what? Maybe they sold a farm and invested it in something other than farm assets. Maybe they sold some quota and invested in something other than farm assets. We have seen a number of offside farm corporations. If your corporation is offside and you pass away with owning the shares of your corporation and it's offside, that's a deemed and it's left to your kids, that's a deemed disposition at death at full market value, fully taxable. There is no tax deferred rollover. So it's very important if you have corporations to constantly monitor them and just make sure they're on side. We have also, when we leave assets in our wills to our children that are eligible farm assets, there's a number of conditions. One, they have to be resident in Canada. So we've run across situations where some kids aren't resident in Canada. They live in other countries, which is fine. But you got to understand we don't get these beneficial rules for assets left to non-resident children. The other requirement, it's sort of hard to explain, but the condition is the asset has to vest indefeasibly in the child within 36 months of the parent's death. That means the child has to get an unconditional, absolute ownership of that property. There's no conditions precedent, so no conditions to get the property. There's no conditions subsequent. There's not all sorts of strings and things attached to it that tell the child that, if you don't do certain things, you don't get it. And there's gray areas for sure. It's a complicated area, but what we have seen in the last number of years is somebody who's already passed away, unfortunately, and we look at these things and we say, well, no, we don't think the asset vests. Now, if the asset doesn't vest, if the farm asset doesn't vest in the child because of the terms of the will or some other document, then it's a deemed disposition at full fair market value again on the death of the parent, and tax is fully applicable. So, it doesn't take much to get over the 1,250,000 gain exemption these days with farms and quota and everything. So if everything you owned as a parent is deemed to be sold on the day you die at what it's worth, what's the tax bill on that? That's sort of what you're looking at if you're not on side these rollover rules. Sharecropping, I think, out in the community, there's different terminology around it, talk at the coffee shops around it. Just to be clear on sharecropping, the government's position has been forever that straight sharecropping is not farming. So getting a share of the crop in lieu of rent is not farming. You are a landlord. That's what you're getting. And there can be situations where the sharecropping goes what the Canada Revenue Agency says is beyond the normal landlord-tenant relationship, and try to make it so that it is farming. But to be clear, if you're in a sharecropping arrangement and you think you're farming because you own a piece of land that you're letting the neighbor sharecrop, and you're not a farmer yourself per se, there's significant risk there. Okay, you have to be farming the farm. You or an eligible farming member of your family have to be farming. You have to be actively engaged in the farm on a regular and continuous basis. That wording is baked right in the Income Tax Act. You have to have the risk of loss, the opportunity of profit. So really, if you want to be farming, you want to be doing it properly, buying all the inputs, paying for the custom work, paying for everything, selling the crop, getting the the revenue for the crop, the sales receipts, and filing a normal farm statement on your tax return. I've seen a lot of cases where people report sharecropping on the farm income tax statement with their tax return. That doesn't mean it's been accepted by the Canada Revenue Agency. Until you're audited, nothing's accepted. And we've run into some situations where we've had to fight on behalf of people with the Canada Revenue Agency who took the position their sharecropping was not farming, but was rent. Okay. The other thing, bit of an issue, is partnership owned farms. And again, it's a question of legalities. Does a partnership own a farm? Is it owned outside the partnership? And, we won't get into all that. There's a lot to look at there. But if a farm is owned by a partnership, that farm cannot be transferred to the children using the rollover rules. So let's say my wife and I have a farm partnership and we have 3 farms that we own in our farm partnership, and we want one farm to go to one child, another farm to go child 2, and the other farm to child 3. What we own our interest in a family farm partnership, we don't technically own those farms as 3 separate farms. They're owned by the partnership itself. So we can transfer our partnership interest to our kids, but we can't transfer those farms individually like that. Now, can we get there? There's a bunch of work we can go through to get the partnership sort of collapsed and wound up without any tax, get the farms out, and then transfer the farms to the kids. But I think that's something that most people don't know about, and it seems to rear its ugly head enough times. Land transfer tax is a big deal in Ontario and provinces where it can be fairly high. We know in Ontario, land transfers tax a lot. If you bought a farm, you know that because it is a percentage of the value of what you've bought. There are exemptions, so be careful. So when I'm transferring a farm from an individual to another individual, from a parent to a child, as long as it was used predominantly in farming before the transfer by the person who's transferring it or an eligible family member, the person getting it's an eligible family member, the principal purpose isn't to enable the child, let's say in my example, getting the farm to continue farming. There are pitfalls here. If you have a farm and your corporation's using the farm and you're not reporting farm activity on your personal tax return, technically the Ontario government says that is not qualifying. If you transfer a farm to a child, as an example, and the child turns around and simply rents that farm to his or her own family farm corporation, that's not going to cut the mustard either. And rental just doesn't cut the mustard at all. So there's pitfalls there just to be wary about. The other one we've seen issues with is transfers from an individual to the family farm corporation or to a corporation. To get the exemption from land transfer tax, the individual has to be farming the farm under his own personal direction. Him or you or an eligible family member has to be farming the farm before the transfer. You're transferring it to a family farm corporation of which all the shareholders are members of the family. And this test is a little higher than the Income Tax Act. In Ontario, they want 95% of the value of the corporation's assets or farming assets to be a family farm corp. You're transferring the farm from yourself to your corporation for the purpose of enabling the corporation to continue farming under the direction of a person who's related to you, one of your kids or some other relative. And again, there's pitfalls here. If it's a transfer to sell the shares, if it's done as a transfer to a company to sell the shares to a third party, it doesn't qualify. If the corporation you're transferring it to is not going to farm the farm itself under your direction or a family member's direction, but instead just holds it and rents it to another family farm corporation, that's not going to qualify. And if you hold a farm now that's being farmed by your corporation and not by you personally, technically it's the corporation already farming the farm as far as the Ontario government's concerned. That's not going to qualify also. Now, as accountants, we don't deal with the land transfer tax. That's the lawyer's purview, but it's certainly, we need to know about it because it's a big part of the planning for succession planning and transition planning and moving farms around, obviously, right? Another thing I want to touch on is probate, or what's called the estate administration tax. Most people, we know it as probate. In Ontario, it's very significant. Some provinces it's not, some provinces it is, but Ontario, it's 1.5% of your assets over 50,000 or something like that. It can add up to a lot. For those of you who have dealt with family members' estates and have dealt with probate, you know it can not only cost a lot, it can freeze things up for a long period of time until the probate is approved, and it can cause a lot of grief. The thing with a will, you have a will. If you have one asset in your will that requires probate, so an investment account in your name or whatever, then the value of all the assets under that will are subject to the probate fee. So if you have one will, something requires probate, the value of everything you own on death is subject to the probate fee. So what's become popular, and I'm sure a lot of you have these, are dual wills. And the idea, if you have a corporation, a private corporation in Ontario, you would have a secondary or corporate will that covers all your investments and shares and loan receivables in the corporations. And you'd have another will, your primary will, I'll call it, that covers everything else. And this has been tested in courts. And the idea is that second or corporate will that leaves the shares of your corporations to your kids or whoever, that doesn't have to go through probate. That value is now carved out. And it's only your main will, if there's something that needs probate, that will covers the probate stuff. So that's fairly well known. The other thing that's out there that's maybe not as well known is in Ontario is a thing called the first dealings exemption. So what the heck that is, if you own farms personally. So in Ontario way back, it was all under the Registry Act. And then over time, they converted everything to electronic under the land title system. And so there's a rule there that says if it's the first dealing with the title of the property since the conversion to the land title system, probate doesn't apply to the farm. So if probate doesn't apply to the farm, then you don't want that farm included in the will that has, say, a bank account or investment that's subject to probate. You'll want to get it in a separate will. So I'm going to give you a real life example. So my parents owned the farm jointly. They always have since, I think in the 70s, they bought it. And my dad passed away about 15 years ago, and the farm went to my mom. She still lives on the farm. That passage from the joint ownership between my mom and dad to just my mom does not taint this. And this is a lawyer's thing. So I went to the lawyer, my mom's lawyer, and I said, hey, does my mom's farm qualify for the first dealings exemption? Will it qualify for not being subject to probate when she dies and leaves the farm to me and my brothers and sister? And the lawyer did their thing and came back and said, yes, it will qualify for the first dealings exemption. I said, great, let's get that farm in a separate will. I just want it carved out in a separate will. I had one lawyer who told me once they had a client who I think did 8 or 9 wills or 10 wills. They did a farm in each will just to be safe. Because the problem is, if something needs probate in a will, then everything covered by that will needs probate. So just putting it out there, like it's something important. Probate can be very high. When I've had this discussion with some clients that didn't know about that rule, just that meeting with them to go through all their farms that could qualify for this exemption, just a couple hour meeting or an hour meeting, we saved hundreds of thousands of dollars. A lot of people will consider joint ownership with their children or others. That's fine, but there are significant legal and tax implications. And I just want people to, think through these things, ask your advisors before you leap. There's HST, income tax, legal, creditor implications that we've seen. So just beware when you're looking at joint ownership with someone other than a spouse, maybe. So in conclusion, assess and evaluate your agriculture tax planning strategies in light of the budget changes and all the other things we talked about. In tax, it's always changing. And one thing I've done this a long time, and I would say in the last 5 to 10 years, there's been more changes than I've ever seen in our tax world in Canada. Engage with advisors who understand the implications and can optimize your planning decisions and know the rules well. Be proactive. Unfortunately, and you don't know if you're not being proactive. I get it, because I see the other side when people come in after loved ones passed away and the tax implications are not good, and they could have had something been done a little differently. And that's the sad part, to be honest, at the end of the day. It never hurts to be proactive and get your wills reviewed by your tax advisor and lawyer. If you have shareholders agreements, partnership agreements, anything, have those all reviewed by your tax advisor to make sure there's not something there that's going to cause a headache for your estate. So being proactive, I think, is the most important thing. Certainly, we have newsletters and updates you can sign up for at our website if you're interested in that. I want to give a shout out to my fellow tax partner, Susan Cruikshank, works with me in our Midwestern Ontario group of offices at M&P, lives over Kincardine Way. She prepared most of the slide deck and is an awesome tax professional in agriculture. And there's our lovely pictures. They've been updated. My hair is way too gray now, but that's life, I guess. Yeah, and the disclaimer: this is not tax advice. Don't run out and do your own thing. Make sure you get a proper tax advisor to help you out, right? Because these are complicated rules. We spend a lot of time trying to keep on top of them, and even us as tax professionals, we struggle with interpretations, and we discuss it within our own tax group. And so I hope that you found this useful, and I thank you very much for spending your valuable time with me. And I thank the OFA for asking me to do this. Appreciate it.
Thank you, Kurt. That's phenomenal information. We do have some time for some questions, so I'll get to those quickly. And just as a reminder to everyone that this will be recording on our YouTube channel, I'll just read them out in order in which they came in here. First one is a question about what are capital gains reserves?
Yeah, so what it is, if you sold a farm to somebody and you did what's called a vendor take back, so you're saying you're going to be the bank and you say, okay, pay me out over the next 5 years, and you might take so much cash down and take the payment over 5 years if you sold your farm to me, let's say. So what the government says is, hey, you're not getting all your cash up front. You're getting your cash spread out over 5 years. We're going to let you take the capital gain on your farm and spread it out over the 5-year period. That's what they call the capital gain reserve. The nice thing with the reserve is it's not mandatory. Each year we sort of look at it for a client and say, how much of the reserve do we want to claim? Because if we can get away not claiming it and bringing more into income and not triggering AMT or OAS clawback, the quicker we can bring it in the income and use the exemption, the quicker it works. But every client's different, so we just do the math. So it's basically, you sell the farm, you didn't get all the cash on closing, somebody owes it to you, it's going to be paid off over a number of years, you can spread it out. If you're selling an eligible farm to children, that reserve becomes a 10-year period. If you're selling your farm to anybody else but your children, it's a 5-year period that we're allowed. Doesn't mean you just have to be paid over 5 years. Maybe they're paying you over 10, but for tax purposes, we can only spread the gain out over 5. Yeah.
Excellent. Next one is, with the current increase in land values and farm assets, why is the capital gain exemption only 1.25 million?
You're asking the wrong guy. You
Yeah.
might want to ask the finance minister or the prime minister.
Yeah.
What's interesting with the farm gain exemption, it was not that many years ago when they said it might disappear and everybody was worried about it being taken away altogether. In 2015, it went to $1 million. So yeah, it hasn't gone up a lot, but what it is, it's $1,250,000. It's now indexed, so it is indexed every year. So I think for 2026 is $1,275,000. It is per person. So what I do say to folks, see your advisor about, hey, there's mom, dad, and how many kids. Each person gets a crack at that $1,250,000 plus. Is there a way to multiply use of that exemption?
Yeah, that's great. And I'll add, we're working on it as well. That's something we've been pushing for as well, is increasing that. Next question, does a relative who crop shares be considered for rollover rules?
Yeah, so your eligible family members are you, your children, and your parents. It goes to grandchildren and great grandchildren, grandparents and great grandparents. In the tax world, nieces, nephews, aunts, and uncles, a big no, and siblings, a big no. So if I own a farm and I rent it to my brother, say I bought a farm and I rent it to my brother who farms, and he's a full-time farmer, he is not an eligible user to me. If I buy a farm and I rent it to my son, who's a full-time farmer, he is an eligible user to me. So it's very important as to who uses the farm. I will say with the intergenerational rules and the farm capital gain exemption, we have a checklist we give the clients to fill out and get us a lot of information. The history of ownership, who's owned it and who's used it, is super, super important.
Yeah.
And it's very important to look at.
Excellent. Next one is, how would capital gains work if, this is a hypothetical situation, if the dad passes and the son was already on title? Would the gains be on the portion received?
Yeah, so, if we assume dad and son are, I don't know if they'd be joint owners with right of survivorship 50-50 or tenants in common, but let's just say they each own 50% of a farm and they were both legal and beneficial owners. They each owned 50%. So when dad died, it'd be his 50% interest. And if it's an eligible farm, it would go tax-free at the original cost to the son. But then what you can do is look at making an election on dad's final tax return if he has any unused capital gain exemption, and get a value on his 50% and say, can we generate a gain on his last tax return to use up his gain exemption? And then the benefit is, like, if dad's half of the farm's worth $1 million and he didn't pay anything for it, let's say not next to nothing, then keep the math simple. You could file an election on dad's final return to show the farm being sold for $1 million, use his capital gain exemption to shelter that so there's no tax. The other great thing is there's no AMT, there's no minimum tax in the year of death, so none of that applies. There might be some OAS clawback, but the benefit of doing that is the child now gets that 50% of the farm with a cost of $1 million, as if the child had paid $1 million for it. And then going forward, the child's only going to be taxable if they sell it over and above that cost. So we've increased the cost for the child by making that election.
Excellent, thank you. The next question, it's a long one. It's kind of someone's personal situation. So I'll just say, if there's personal tax questions you have, I'd recommend you maybe get in touch with your MNP accountant locally to review them. So in the interest of time, because we are bumping up on one, we might go over for a few minutes. I'm going to skip those questions that are more of, here's my situation. And then I also see one that's for OFA on requirements of, I believe there's some beneficial ownership for farm property tax programs. Michael, please email me. I'll put my email. This was a question directly for me. I'll put my email in the chat. Please email me your question, and I'm happy to chat with you. The next question here is, does RIF money count against AMT?
Yes, 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 yes. I see. Like if you had to pay AMT because you sold the farm, and now we're in the 7-year carry forward trying to say, where can we generate income to use up that AMT? Absolutely. We can cash out RSPs or RIFs. We've actually modeled that in some of our planning. Where actually we've had somebody who sold a property at a very large capital gain, well in excess of their gain exemption, and they have lots of unused RSP room because they've never really bought any. We said, go out and buy it all. And then in the following 7 years, or maybe even the next year, we'll start cashing it all in to generate income to use up the AMT. Now, that's at a very high level, folks. We do the math, we do the modeling, we have software to do it because every fact situation is different. The AMT calculation is a beast, to be honest about it. It's just a beast. So
absolutely. Okay, a few more here if we have a couple minutes.
sure.
Next one is, what was the year of land registry conversion?
Yeah, that's a good question. So it seems, and I'm not a lawyer, but it seems to differentiate across the province when they started transferring over to land titles. If there's a lawyer on the call, maybe they can type it in or whatever. But I've seen it in the 90s, 80s, and 90s, or in early 2000s that sometimes they'll qualify or not. So what I do is I just go to the lawyer. They go pull those parcel registry reports from Service Ontario, that have the pins and all the details of your farm. And on there's some language where they can tell if it qualifies for the first dealing exemption. So it's been very helpful for me and my clients, and even me personally, as I mentioned with my family's farm, just to reach out to the lawyer and say, hey, does it qualify for this? And we've had some clients who own a whole bunch of farms, and a bunch of them qualify and some of them don't, and that's fine, but at least we know what we're dealing with then, right?
Excellent. And I think we have one more question here. So this, I'll get us out of here without too much overtime. Could you explain about probate again? And should someone have two wills if they have a farm and investments, including bank accounts? So I guess if there's multiple different types of assets here.
Yep. Yeah, I think so. So we're seeing, like, if you own farms personally and you have investments personally and bank accounts personally that are sort of all just in your name, and you have one will, so you die and you're the survivor of you and your spouse, and it's all going to your kids, and that's fine. But you got the bank accounts just in your name, and maybe an investment account at the local bank or an investment advisor in your name, other stuff. So you go to those institutions and they'll say, we want probate. We won't release anything without a probated will. So you go to get probate. The value of everything you own on death that's in your name alone, that's not joint with right of survivorship, will be subject to the probate fee. So if you have one will, it's going to include your farms too, and your investment accounts and your bank accounts and everything, right? And that's going to be subject to the probate fee. If the farms you own personally are eligible for this first dealing exemption, so simply ask the lawyer, is it eligible for the first dealing exemption? And the answer is yes, then get those farms in a separate will, so they're not subject to probate. And then your separate, so your main will just cover your investment accounts and your bank account now. And you got this other will that says, I leave my farm to whatever children I'm leaving it to. The value of the farm then will avoid probate as long as it still qualifies for the first dealing exemption when you die. And I think that's why some people who have lots of farms and the willingness to do this, maybe, to be honest, use maybe a separate will for each farm that does qualify for the exemption. Because if you do something to the title before you die, that you've converted the title, then all of a sudden it doesn't qualify. Then everything in the will again subject to probate. So it can get a little tricky, but you need proper legal advice, really good legal advice with lawyers that understand the first dealing exemptions in agriculture, along with your tax advisor, and yeah, just work through it. It can save. I've seen it in real life. It can save a lot of money. Yeah.
Excellent. Thank you. And at that point, we will wrap it up. So thank you so much, Kurt, for taking the time. Thank you to everyone for joining the webinar today. Once again, we will have the slides and the webinar recording on the website and OFA's YouTube channel. Really appreciate everyone taking the time. Thank you so much.
Yep. Thank you very much. Merry Christmas. Happy New Year to everybody. Have a nice day. Bye for now.